Well, thanks for being with me here at Money with Mark Albert, where we are on a smart money question series where we look at smart questions to guide your estate tax and legacy plans. And today we're looking at question five. Be grateful if you subscribe to this channel and give a thumbs up to the video. If you like it, that'd be wonderful. Today's question is what major life events mean it's time to review or update your life insurance coverage? So that's today's question. We're going to look at that. I'm going to comment. I'm going to give you six key areas, and then we'll see if you want to talk more. You would let me know. So life insurance, basically, it's not a set it and forget it financial tool. A lot of people think it like that, like it's a transactional tool. And yes, it is a transaction in the sense you have to submit an application, get approved by underwriting, and so on. But it's part of an overall estate planning strategy, a financial strategy. It protects your family in terms of vulnerability in the most vulnerable years, but also in the estate planning concept as well. As your family, career, and liability, so the debt that you may have, as these things evolve, the coverage you purchased years ago can quickly become either insufficient, not enough, or unnecessarily expensive. So that can happen sometimes with term life insurance in the later years. That's why you need to implement the concept of buying term and invest the difference so that you can build your wealth over the vulnerable years with a low cost, maximum protection on term life insurance. So some would say that you should review your policy every year, every 2 years. They think it's a good practice. That's not necessarily my position on that. Um, if you think it through, right, this is what I like to do. I help people think it through. Every 5 years, that window of time, there's usually a major life change in everybody's life, right? So there was a time when I was single, and then eventually, I got married, and then within the first 5 years, we had a child, and then we eventually bought a house, right? And sometimes they delay having the children, so maybe like within the first 10 years, but then they'll buy a house in there, and then before you know it, there's the kids' education. They're going to university and college, and the kids are still dependent on you. And there may be job shifts. And then sometimes one parent may live at home to take care of the kids. So, in any case, a periodic review, and one way that I also like to consider is when there's key triggers. So, key life milestones. And that should immediately trigger a revaluation to keep protection aligned with your current reality. And so here's some things. So if you get married, or if you're widow or widower, or you are separating, you get remarried, or separation and divorce, these things should trigger a sense of reevaluation. All right. Some of this could be very complex, and you just want to get it right. So this matters because getting married usually means combining finances. You share debt on mortgage. You might be relying on two incomes to make ends meet. So if one of the spouses passes away, the income of that one spouse that passed away makes it so that life insurance becomes something that allows for your family not to experience financial devastation. In the worst possible time in a family's life, when mom or dad passes away, you don't want to also experience devastation in the financial front as well. So separation and divorce, that requires updating beneficiaries usually. Okay, you got to rethink through your beneficiary designations. You might have to remove a former spouse from either life insurance, your investments, may also be a time to redo your will. There may be court mandated spousal support or child support obligations that life insurance might be required. And so these adjustments, it could simply be increasing coverage to protect your spouse's standard of living, could be adjusting the beneficiary structure. And these are some things it should trigger a reevaluation. Another one is if you have a baby, right? A baby or you adopt a child, these things, think about it this way. You have a baby, you basically a new child that introduces at least 18 years of daily expenses to the household, childcare costs, and the future possible post-secondary education, right? So if if one parent steps back from working to raise the child, that means that the parent that's actually working may require significant more of life insurance protection on their life because if they pass away, it'd be really bad. But even the parent that is at home with the child, there's a cost associated, there's a value associated with the child care and everything that a parent does when they're home with their children. So the financial impact of losing either the income of the employed spouse or the caregiver within the family, these things may require to be reevaluated. And so that's something that needs to be thought through. Another trigger would be you're buying a house or you're adding any major debt. In this case, it would be mortgage. And, that's usually the largest financial obligation or liability that a family has is a mortgage. So if the income earner passes away unexpectedly, the surviving family members could be forced to have to sell or downsize. Or if they can't sell and there's no financial ability, then the banks may take possession of the house there if they keep missing too many payments. And so align your term length. So if you have term life insurance, you could align that up. The coverage amount may have to be adjusted based on the size of the debt, just to just to make sure that the family's properly protected if the income earner passes away. So another one would be, hey, listen, great news. You just got promoted. You've got a significant increase of your income, but this may also be a reason to um, reevaluate. So often it elevates. See, this is the pattern. Normally, when people keep getting raises in their income, they start spending more. Their lifestyle changes, and so to maintain the lifestyle that their family has chosen, sometimes you need to adapt and adjust the size of the life insurance policy. Um, So like I like to do, 10 times if I was putting life insurance protection, if someone got an increase, right? We'd look at, well, how much do you currently have? And but ideally you want 10 times your salary or 10 times your income. Um, that would be the face amount. So if you already have a percentage of that, just add a bit more so you get maybe another policy to top that up. Another one here would be let's say you're a bit older, the kids have left home, you've paid off your mortgage. So once the children are financially independent, major debts likely are paid off. Your need for a large term life insurance policy may not be as needed. So oftentimes you can adapt. You might be able to decrease the protection, or another thing you could do is you can convert that over to a permanent life insurance policy. And because the greater need may shift to your estate so that you could be more tax efficient and to preserve the wealth that you have built and this concept of legacy planning. Um, there may be a charitable organization that you may just have to, you may want to adapt your beneficiary designation because your estate might benefit from uh, the non-refundable tax credit from the donation. And the last one we're going to look at is a health status shift. So, what sometimes happens, people they'll get a life insurance policy, and maybe they're a smoker, and so they get rated as a smoker. So they get a rate, they pay a higher rate than a non-smoker. So life insurance companies, they generally will have a way that if you go 12 consecutive months without smoking, then they may have you sign an attestation declaring that, and then you can reapply to go back to normal rates. And so that's something to consider. Sometimes, if because what they do a lot of times on these policies is there'll be a height weight measurement. And if you are significantly, if your weight is very significant in compared to your height, they may rate you for health reasons. So you may be paying a higher premium. But they may also give you a letter, with the policy saying that if you were to get your weight to this level, we would be happy to reevaluate and so that your premiums can go down. So those are some things that can happen. And so, sometimes you got to reevaluate. I think within every 5-year window of time, everyone should do some level of revaluation, especially if there's changes. But I like to think about these trigger events. If you do want to discuss that with me, I work here in Ontario. My contact information is there. Be happy to help you over the phone or on a Zoom call. And listen, I thank you for being with me. Please subscribe to the channel if you haven't already. Have yourself a wonderful day, and I very much look forward to talking to you soon. Take care.